I've done a lot of videos now explaining how buying a low-cost global equity index fund and holding for the long term is a very difficult strategy to beat in the accumulation phase when working towards financial independence. But some people may want to add some bond exposure to smooth the ride, or as they approach financial independence and plan to start living from their portfolio. So what are the options? The Simple Path to Wealth suggests a US total market bond fund which provides broad exposure to US investment grade bonds, including both government and corporate bonds, but this is a US focused book, so probably not as relevant for people outside the US. Investing Demystified by Lars Kroyer recommends buying government bonds in your home currency, so for UK based investors this is UK gilts, or US treasuries for US based investors. Lars also recommends adding other global government bonds and corporate bonds for additional diversification if you don't mind having more complexity in your portfolio. So should we go global or stay local? Stick to government bonds or add in corporate bonds? Vanguard produced a research paper looking into this issue called Going Global with Bonds, the benefits of a more global fixed income allocation. The researchers analysed the data and concluded that investors should consider going global with their bond allocation, as it gives them exposure to the greatest number of securities, markets, and economic and inflationary environments than they would have by sticking to their local market. They analysed this across 5 markets: the US, Canada, the UK, the Euro area, and Australia, and found that portfolio volatility was reduced across all regions without decreasing total return when allocating fixed income to global bonds. As you can see here, the key was to make sure that the bonds are hedged back to the investor's local currency, which resulted in a lower annualised volatility. So, as a UK-based Vanguard investor, if I choose to add a bond allocation to my portfolio, I'll be looking at adding one of the following 2 funds. The Vanguard Global Aggregate Bond UCITS ETF, ticker symbol VAGP, which holds around 6,273 bonds with an ongoing charge figure of 0.1%. Or the Vanguard Global Bond Index Fund, which holds around 12,682 bonds with a slightly higher ongoing charge figure of 0.15%. Both funds track the Bloomberg Global Aggregate Float Adjusted and Scaled Index, which is a market-weighted index of global government-related agencies, corporate and securitized fixed income investments with maturities greater than 1 year. Both of these funds are also hedged back to the pound. The main thing that I would want from a bond fund is stability when there is a lot of market volatility around, meaning that I wouldn't be a forced seller of equities when they have dropped. So when looking at the performance of the Global Bond Index Fund, I was pleased to see that it had sailed through the recent market turmoil in the first and second quarters of 2020. Let me know in the comments what you think to bonds and whether it makes sense to go global or stay with the local market. As always, thanks for watching and I'll see you next time.